Imagine this. You walk into a store, buy a $100 item, swipe your credit card and leave. Simple, right? But behind that one swipe, a massive money-making machine has just gone to work. The bank earns money, the credit card network earns money, the merchant pays fees. And if you don't pay your bill on time, the bank can earn even more. In fact, credit card companies make hundreds of billions of dollars every year from millions of people doing exactly what you just did. So how does a simple piece of plastic generate so much money? Today, we're uncovering the hidden business model behind credit cards.
Credit cards weren't always everywhere. Decades ago, people mainly used cash. Then banks realized something powerful. What if people could spend money before they actually had it? This idea transformed consumer spending. Instead of waiting until payday, people could buy products immediately and pay later. Convenience exploded, and so did profits. Today, millions of Americans use credit cards daily for groceries, gas, online shopping, travel, and almost everything else. But the real question is, how do credit card companies actually make money?
Every time you swipe your card, the merchant pays a fee. Let's say you buy a $100 product. The store doesn't receive the full $100. Instead, a small percentage goes to banks and payment networks. This is called an interchange fee. Most customers never notice it, but these tiny fees add up. Millions of transactions happen every day. A few dollars from each purchase becomes billions over time. Even when you pay your credit card bill in full every month, the system is still making money from your spending. This is one of the biggest revenue sources in the credit card industry.
Now let's talk about where the biggest profits come from. Interest. Suppose you spend $5,000 on your credit card. At the end of the month, instead of paying the entire balance, you only make the minimum payment. The remaining balance stays on the card, and that's where interest begins. Many credit cards charge extremely high interest rates. Over time, interest can turn a small balance into a much larger debt. For banks, this is incredibly profitable. Millions of customers carry balances every month, and the interest payments continue flowing in. This is why banks love customers who revolve balances rather than paying everything off immediately.
Have you ever missed a payment? Banks know it happens, and they charge for it. Late fees may seem small at first, but across millions of customers, they generate enormous revenue. Some cards may also increase interest rates after repeated missed payments. For consumers, this can make debt much harder to escape. For banks, it's another stream of income.
Not all credit cards are free. Many premium cards charge annual fees. Some people willingly pay hundreds of dollars every year. Why? Because they receive rewards, travel benefits, airport lounge access, cashback, and other perks. Banks collect these annual fees while attracting high-spending customers. It's a win-win for the bank.
Many people think rewards programs are costing banks, but the reality is more complicated. Rewards encourage customers to spend more. The more you swipe, the more transaction fees banks collect. Many customers also carry balances, generating interest income. So even after giving cash back and points, banks can still make huge profits. The rewards aren't just gifts. They're part of a carefully designed business strategy.
Here's something fascinating. Studies have shown that people often spend more when using cards compared to cash. Why? Because swiping a card feels less painful than handing over physical money. This psychological effect encourages higher spending. Higher spending means more transaction fees and potentially more debt, which means more revenue for the financial system. The entire ecosystem benefits when consumers spend more.
So how do credit card companies make billions? The answer is surprisingly simple. They earn from swipe fees, interest charges, late fees, annual fees, and rewards-driven spending.
Every time a card is used, money flows through a complex financial network. For consumers, credit cards can be powerful tools when used responsibly. But when debt starts piling up, that same convenience can become extremely expensive. The biggest lesson? Use credit cards as a tool. Don't become the product. If you enjoyed this video, subscribe to USA Wire for more deep dives into money, business, investing, insurance, and the financial systems shaping America. Thanks for watching.